Hi everyone, welcome back to Tax Tutoring and Training. My name's Hannah, and today's lesson is on retirement income and how to note that when preparing an income tax return. As always, guided notes are linked in the description below. Print them out, follow them, stay engaged, and complete the activities at the end to see how much you learned and to use as a reference material when taking your certification exams. All right, let's get started. So, what is retirement income? Retirement income can include Social Security benefits as well as benefits from annuities, retirement or profit sharing plans, insurance contracts, IRAs, etc. And IRAs are individual retirement arrangements. We'll get more onto those later. But why would you need to know this? So, when preparing tax returns for clients as a VITA intern, you're going to need to, sometimes they'll have retirement income that they'll get when either they retire or when they reach a certain age limit. And you need to know how to transfer that information from the documents they bring in into the tax return or tax return software in order to get them to have the correctly taxed amount on their return. So, what you need to know about retirement income is that it could be fully or partially taxable. And you need to know how much should be taxed and how much shouldn't be taxed in order to complete an accurate return. So, where is retirement income going to be found? When your clients come in, they'll often bring a bunch of forms that have certain income, and some of those forms might be the 1099-R series, delineating any retirement income they may have received. And these includes forms such as the 1099-R, Form CSA 1099-R, Form CSF 1099-R, Form RRB 1099, and Form RRB 1099-R. And these are just some of the forms that will list any retirement income that your client has had, and you'll be able to take the numbers from those forms and transfer it into the tax return. If the taxable amount is not already indicated, you must calculate the taxable portion using the simplified method. And we'll show you how to use that method later. And you need to know this, though, so that you can calculate the exact tax that the person will need to pay to complete an accurate return. Listed on each of the forms I mentioned above, they'll have the gross amount and the tax amount usually, and except, of course, when you need to calculate it when they're not listed. And we'll show you how to do that for this certification. So, retirement plan distributions. So, we talked about retirement income, and how the income is going to come in is through what we call distributions. And these are basically payments made from a retirement plan. And retirement plans are funded by either before tax contributions or after tax contributions. And contributions are just basically the money you pay into the plan. Before tax contributions is where employees did not pay taxes on the money at the time it was contributed. And in this case, distribution and interest will be fully taxable, but they'll be deferred. So what happens in these plans is that the employee, they get a gross pay, and they put some of that gross pay into a retirement plan before any withheld taxes are taken to their gross pay. So they don't pay with their net pay, they pay from their gross pay in a working situation. And they'll go into the retirement plan, they'll save it until they retire, in which case they'll be paid distributions. Now, because you didn't pay tax distributions when you were putting money into the account, you will have to pay tax on the distributions when you take the money out, when you receive it. After tax contributions are where employees paid taxes on the money when it was contributed, and meaning that they have cost basis in the account. So this is when an employee would get their take-home salary, their net pay, and then they'd put it into a retirement account. In which case, you wouldn't have to pay you wouldn't have to pay tax on it when you take the distributions out. However, sometimes retirement plans will be eligible for interest or have earnings at the end of it when you take out the money. Since you didn't pay taxes on these earnings, unless it's a Roth account, since you didn't pay tax on these earnings, you might have to pay them even if you made an after-tax contribution in the first place. So in this case, distributions, like I said, they'll be partially taxable, and the portion considered a return is not taxed. If the taxpayer did not contribute to the retirement plan, meaning it was a fully employer-funded retirement plan, all distributions are fully taxable because the taxpayer didn't pay tax yet. You always have to pay the government, unfortunately. But now we're going to go into the types of retirement plan distributions. And the first type we're going to be going over are IRA distributions, individual retirement account distributions. And there are 4 types of individual retirement account distributions. These include the traditional IRA, which is fully taxable unless non-deductible contributions have been made. Non-deductible contributions are out of scope. Non-deductible basically means you can take the amount you paid into this off your income, meaning you'll be taxed at a lower bracket on your income. But if the taxpayer has non-deductible contributions, then it's out of scope for the VITA program, and you should refer them to a professional taxpayer. Contributions are, like I said, the amount deposited into an IRA. Deductions are portions of the contributions that is deducted on a tax return. And non-deductible contributions, like I said, they're partially taxable, they're out of scope, and we won't be covering them. The next IRA distribution that you need to know about is the Roth IRA. And these are qualified distributions that are tax-free and may be eligible to be excluded from income. A qualified distribution is basically, so you're eligible to take money out. Any money you take out of a retirement plan is a distribution. But what qualifies as a qualified distribution for a Roth IRA means that you won't have to pay tax when you pay it out. In order to have your distribution be qualified, the distribution must be withdrawn after 5 years of being made, meaning that your Roth IRA has to be present for 5 years before you start drawing money out. It must be made on or after age 59 and a half. So the distribution must be done after you're 59 and a half. The distribution was made either because the taxpayer was disabled. So if the taxpayer is disabled and they withdraw it to help with their living if they're disabled, then that would be considered a qualified distribution and would be tax-free. The same thing if the distribution was made to a beneficiary or an estate, or to pay certain qualified first home buyer accounts. If the above requirements are not met, then the distribution is non-qualified and additional taxes may apply, in which case it's out of scope for VITA interns. We only are dealing with Roth IRAs as they are tax-free or have had qualified distributions. Okay, so the next taxable IRA distribution that you may come into contact with is a savings incentive match program, or simple IRA. Then this is where it's an employer program to offer employees a chance to contribute part of their pay to an IRA. In this case, the employer generally makes contributions on behalf of the employees and thus is not included in income. So the employee would say, I would like to withhold some money for the simple IRA, and the employer would withhold that money, not give it to them in their income, and put it in the IRA. But this also means that it's fully taxable because it's not part of their net income, it's part of their gross, meaning they never touch the money. It all goes through their employer, meaning that they will eventually have to pay tax on the distributions in later years. The Simplified Employee Pension Program, or SEP IRA, is where employers offer employees an additional chance to contribute part of their pay to an IRA. This is also not included in income and fully taxable. So you might be wondering, what's the difference between these two? Well, a SEP IRA allows contributions through the employer, while Simple is a match program, meaning that in SEP, it's only the employer putting money into the IRA, whereas Simple might be, your employer might offer, hey, if you want to put in $10,000 to the Simple IRA, I'll put in $10,000, and it's a match program. IRAs are subject to varying rates of additional tax if distributions are pulled out early. Like we mentioned with the Roth, distributions must be qualified, meaning that they can't be early distributions, because IRA distributions, the whole point of them is to be a retirement account. So if you pull them out when you're 30, it's going to be subject to additional tax rate in order to put an incentive for you to not do that and for you to save for later. Okay, so with talking about IRAs, we also come into the concept of rollovers. And rollovers are tax-free distributions to the taxpayer from one retirement account that rolls into another qualified retirement account within 60 days. So sometimes you're going to have taxpayers who have moved jobs, meaning that they were at one job with a retirement account, a qualified retirement account, or an IRA that they were paying with their employer. So say they were using a simple IRA, and then they quit that job and moved to another job. Well, the taxpayer would need to roll over that retirement fund so they can still take part of it when they retire. If they're able to do it, and they do this by taking a distribution from the simple IRA that they came from and putting it in another simple IRA to maintain the money. If you're doing this, if it's a rollover, it will be tax-free if the taxpayer is able to roll over the money from their first retirement account into the second within 60 days. If it's over 60 days, they're subject to more tax and will thus have to pay that, and they'll have to seek help from a professional taxpayer since VITA interns are not allowed to do additional tax on rollovers. So, like we said, in order for it to be a rollover, you have to see documentation that it is a rollover, and that'll be indicated on Form 1099 Code G. Simple IRAs can only roll into simple IRAs, and Roth IRAs can only roll into Roth IRAs. These are the two that have to be maintained. You have to roll a simple IRA into a simple IRA and a Roth IRA into a Roth IRA. Rollovers that are within the time frame are excluded from income and tax. It's like no money was ever taken out. You're moving it straight into another retirement account, even though you're first taking it out, putting it in your income and paying it back. It's not treated like that. It's not treated as income and taxed. It's treated as if it were going straight into another account. But you still have to report any rollovers on the tax return. A qualified plan loan offset distribution. Well, this is something that you can recommend to taxpayers because it's a a qualified plan loan offset distribution is a plan of termination or severance from employment instead of the 60-day rollover period. In this case, the company will give this to the taxpayer, and that means they have to roll over their accounts by the due date, not by the 60-day period. So make sure you watch out for that if they bring that along as well. The IRS self-certification procedure is something you can recommend to taxpayers to get an extension for those who missed the 60-day time period. And it's something you should recommend if they did and they might still qualify, but this is basically to get them out of that additional tax. Another concept we're going to be going over with IRAs are qualified charitable distributions. And these are non-taxable distributions made directly from a traditional IRA to an organization eligible to receive tax-deductible contributions. To do this, a taxpayer must be at least 70 and a half, and this would then count towards the required minimum distribution that most taxpayers will have to take when they have an IRA. And we'll get more into required minimum distributions later, but for now, qualified charitable donations would count towards the required minimum distribution. And in order for it to be a qualified charitable distribution, the taxpayer must have documentation of the donations. That could be either an issue from the organization or any documentation, any receipts, that sort of thing. The maximum annual exclusion for qualified charitable distributions is $100,000, and anything over is included as income. Meaning that even if you paid $120,000 into a qualified charitable donations, that $25 is still included as income. Meaning you can't exclude it. Meaning it doesn't count. Meaning you can't exclude it. So basically what this means, when you do a qualified charitable distribution, the money goes straight from your IRA into the organization. You pay out to the organization, meaning it doesn't go to you, meaning you don't have to list it as income. And therefore, it's not contributing to growing your tax rate. But if it's over that $100,000 threshold, the $100,000 will go towards the organization that you decide, but the $20,000 is not covered in that $100,000, and it will go to you into income, even if you still pay it to the organization. All right. The second category of retirement income are taxable pensions and annuities. So we went over individual retirement accounts. Now we're talking about taxable pensions and annuities. Taxable pensions and annuities are fully taxable if the following are true. If the taxpayer paid no cost of pensions and annuities, if employers did not withhold part of the cost from from the taxpayers' pay while they worked, or employers withheld part of the cost from the taxpayers before tax paid while they worked. Partially taxable pensions and annuities are when the taxpayer made after-tax contributions towards their retirement plan. So this is kind of what we talked about, where the taxpayer got their net income, their take-home pay, and then they made contributions toward a retirement plan, meaning they already paid tax on the money that they put towards their retirement plan. But in a retirement plan, you earn as the money ages before you pull it out in distributions when you get older. So that money that's earned, not the one that they already paid, but the money that is earned then becomes eligible for tax because they have not yet paid tax on it. It's interest, therefore you pay tax. You have to calculate what percentage that is so that you can denote how much tax they have to pay on that. And how do we calculate this? Well, we're going to be covering the simplified method, which is what I kind of talked about in the beginning of the lesson. So this is how to calculate the portion of tax in a retirement account that the taxpayer needs to pay and the portion of the retirement account that the taxpayer doesn't need to pay, or the taxpayer's basis. Okay. So the simplified method. The simplified method, again, it's used to calculate the tax-free portion of each pension or annuity payment. And the equation for the simplified method is the taxpayer's cost basis, which is basically how much after-tax dollars they put into the plan, divided by the number of monthly payments, so the number of times they paid a contribution, equals the monthly tax-free portion. So that's how much money of the distribution they won't have to pay tax on. If you subtract that from the total portion of the distribution of the pension or annuity, then you get the taxable portion, and that's the money that the taxpayer would need to pay tax on when they get a distribution from an annuity or a pension. Now, how do we determine the number of monthly payments? Well, you must have the age of the taxpayer at the annuity start date or the pension start date. You must have the age of the taxpayer at the annuity start date. And that's how you basically know, like, okay, they started at this date and they thus paid until present, or however many years they paid, and that's how many monthly payments they had, times by 12. So to calculate the taxable portion, you need the cost in the original, like I mentioned, you need the cost in the original plan, so the total employee contribution, the taxpayer's age to calculate the number of monthly payments, right there, and you need the total tax-free amounts from previous years. Disability payments are taxed as wages until the taxpayer reaches the minimum retirement age set by the employer. So they're treated a little differently than a pension or annuity in that they are taxed as wages, meaning they go to income and not the appropriate schedules for retirement income. They go to the wage income section, not the retirement income section, until they meet the retirement age. Okay. Some other retirement income issues that you're going to be coming in contact with as a VITA volunteer are lump sum distributions. So lump sum distributions are distributions or payment within one tax year of an employee's entire balance, or within one tax year from, Lump sum distributions are distributions or payment within one tax year of an employee's entire balance from all qualified stock, bonus, or profit sharing plans that the employer maintains. There are special tax treatments in Code A that are out of scope, but basically lump sum distributions is where a taxpayer takes the entire balance, so everything from qualified pensions, anything from IRAs, anything from their employer's retirement accounts, and they take it all out in one lump sum distribution. Early distributions are another issue, and this is where withdrawal from a retirement fund is done by a taxpayer who's under age 59 and a half. And in this case, it'll be subject to 10% tax. If it is subject to the 10% tax, you as a VITA volunteer are not able to complete the return as it's too complicated, and you should refer the taxpayer to a professional tax preparer. Another retirement income issue that you might come into contact is required minimum distributions. So we talked a little bit about required minimum distributions with the qualified charitable distributions. So with required minimum distributions, this is basically a rule that states that taxpayers must take out a certain amount by a specified date to avoid additional excess accumulation tax. So when you have an IRA, you're required and you reach a certain age, you're required to take out minimum distributions because the government doesn't want you accumulating too much wealth. So you're required to take out a minimum distribution of such money from your retirement account each year. And this starts April 1st of the calendar year after the taxpayer's 72nd birthday. And it's actually their 73rd birthday if this occurs after 22. Or this starts when they retire, when the taxpayer retires. Taxpayers must receive the minimum distribution by the end of the year. So December 31st, end of the tax year. If no distribution is received during the taxpayer's starting year, meaning that they didn't begin to take out the required minimum distribution by the end of the year, then the required minimum distribution for 2 years must be received the following year. One distribution, so they would have to take double the amount the second year, and one of that amount, so one distribution, must be taken by April 1st. The other can be taken anywhere from the start of the year to December 31st. So we talked about required minimum distributions. Now we're going to go into excess IRA contributions. And this is where sometimes there's a limit to the amount able to be contributed to a traditional or Roth IRA each year. And this is where the taxpayer goes extra or above that limit. So an excess IRA contribution is the amount contributed to a traditional or Roth IRA is greater than the smaller of a maximum IRA amount for the year based on the taxpayer's age or the taxable compensation for the year. This excess contribution must be withdrawn before the due date of the return, or it's subject to an additional 6% tax. If you withdraw the excess sum, it will not be included in the gross income if no deduction was allowed for the excess contribution, and all interest or other income earned on the excess contribution is also withdrawn by the due date of the return. Earnings of the excess contribution is reported as income. So you put in more than you should into your IRA, it earns money. You're not supposed to put in more than you should, and you take all the money that was earned on the over amount. That money that you earned is also subject to tax, and it will be reported on income. The last issue that you might come in contact with in regards to retirement is retired public safety officers. And these taxpayers can include from income distributions up to $3,000 if they're used to pay premiums for accident, health, or long-term care insurance. So a retired public safety officer might pull out $2,000 early from their IRA to pay premiums for accident, health, or long-term credit care insurance. They're able to do that, and they can exclude those distributions. And then the final thing we're going to go over is adjustments to withholding. So taxpayers may choose to withhold some income tax from their retirement distributions each year, meaning that they'll decide to pay the government a little bit of tax throughout the year with regards to their retirement distributions. If the taxpayer owes $1,000 or more, suggest at the end of the year during the return, you should, as a VITA intern, you should suggest withholding the estimated tax options. You should suggest withholding an estimated tax options with them, meaning you should point them in the direction of maybe withholding a little bit more so that they don't have to pay as much during the end of the year when the recording's due. If the taxpayer had a large refund, tax withholding should be suggested to be lowered, and you should discuss this with the taxpayer, meaning that they shouldn't pay withheld payments as much as they should because they have a really large refund and they're going to need to get that money back anyway. Taxpayers who choose not to have their tax withheld may have to pay an estimated tax each quarter. All right, that's all I have for you about learning how to record retirement income as a VITA volunteer. I hope you guys learned something. I hope you are a little bit more clear on what retirement income is and the rules with regards to retirement income and taxing them on your tax return. All right, guys, thanks for listening, and I'll see you next time. Have a great day.